Good afternoon. Welcome to a special asset management webcast for Sommerset Place, hosted by Investors Management Group. Presenting on today's webcast are Michelle Rivnak, Managing Director of Asset Management, and myself, Dave Mickelson, Investor Relations Manager. Thank you for making the time to join with us today. The schedule for today's presentation is a little different than what we typically do, as we just hosted our first quarter webcast last month, and generally we only host calls every quarter. But plans for the special webcast today came about because the real estate market and the national economy have been impacted by COVID epidemic to such a degree, and we thought that it would be valuable to update you on your investments performance between the first and the second quarter calls. On today's special presentation, our information in the presentation will be shorter as we've condensed the material that we'll be covering. We'll review a sensitivity analysis, update on the property reserves, collections, and news, similar to our reviews of those topics on the first quarter call. Then a new subject for today will be the 2020 budget reforecast. That reforecast will combine an assessment of actual operations to date with how we see the balance of the year likely to play out. Let me point out a few administrative features for the webcast. First, participants will be in listen-only mode for better audio quality. And second, Michelle and I will look forward to responding to any questions in a Q&A session to close the webcast. To submit a question, you can send questions through the live chat pane if you're using the GoToMeeting application. You can also send an email to me either at david.mickelson@imgre.com or to investor.relations@imgre.com. I'll collect the questions during the presentation and we'll address those at the end. With that introduction, I'll move into the first set of slides discussing our break-even sensitivity analysis. So for those on our first quarter call last month, this sensitivity will look familiar. As a quick refresher, the goal with this analysis is to gauge what the property income collection rate needs to be in order to break even, or in other words, what income we need to pay all of our operating expenses, debt service, and capital improvements. Income collections have been a daily focus of the asset management team, and it's really a key statistic that we track for all of our properties daily. So using this analysis here, if you look to the column on the left, these are our historical averages for income and expenses, and we use this as a baseline. In the middle column, this is the break-even that we presented back in April, and one of the big drivers here was the debt service rate and the amount. So if you're looking at the bottom half of that column, you'll see an effective interest rate of 3.22%, which equates to an annualized mortgage interest payment of about $334,000. At that debt service amount and with the expense assumptions that we've made here, the net collection rate needs to be 77% of average in order to break even. Now, if you look to the column on the right, this is that same information but updated for May. The big driver again is the cost of debt. So if you're looking at the effective interest rate, you'll see in that column the rate is 2.72% for an annualized mortgage interest payment of about $282,000. The difference here is the fact that the LIBOR rate back in April was about 100 basis points. Here we are a month later. At the beginning of May, the LIBOR rate was about 50 basis points. And so with the savings and debt, if you go back up to the top, you can see our break-even income collection number is 74%. So we gain an additional 3% here with the reduction in the debt expense. As we move to the next slide, I'll review quickly some of the assumptions and some of the meaning for this analysis. So again, for April, the break-even number was 77% of average income. We made small fine-tuning by increasing utilities expense to assume that there would be more people at home. Also, like I mentioned, the LIBOR rate at that point in time was 1.0%. And then in both assumptions, we've assumed that $100,000 a year would be required for capitalized expenses. Here in May, the LIBOR rate has dropped to 0.5%, giving us an all-in interest rate of 2.72%. That versus May versus April represents about a $53,000 reduction in annual debt service payments. And another note to add is that LIBOR has continued to drop since the beginning of May. So as of the last couple days, LIBOR was down to about 17 basis points, which would be an additional huge savings, if we were to recalculate at this rate for June. So definitely are appreciating the fact that LIBOR is working with us in our favor, gives us greater room for cash flow. And then if we're looking at the sensitivity analysis, it gives us more room for property break even. So in May, that number fell to 74%, and assume that that would drop again if the LIBOR keeps kind of its downward trend. So that's a measure to keep in mind as Michelle talks about our collections rate later in the presentation. But for the next measure of the investment, let me turn it over to Michelle, and she can talk about the property reserves.
Thank you, Dave. As you see here, we have a high-level reserve summary, and it's split into two categories: what is owner-controlled and what is lender-controlled. So starting at the top, we have our operating account that has $279,000. Our capital reserve account is at $193,000. Those combine for a total owner-held reserve of $472,344. The replacement reserve that we have with the lender is at $28,991. We don't have any capital reserve as we've gone through and done the majority of everything that was scheduled at Sommerset. And then the last account you see here is the combined taxes and insurance and the rate cap escrow, and that totals $99,127. So sitting with the lender, we have a total of $128,118. If you take our owner held and combine it with the lender held, the complete total reserve account is at $600,461. So that's just a high level kind of review, so you're comfortable with the reserves that we have on hand. Then I'd like to actually go into our collections. As Dave mentioned, we are, tracking this on a daily basis, and walking through Sommerset, I can take you through kind of where we're at in May and how we ended April and what our outlook is. So the top line there, you can see as of May 22nd, last week, we had billed in rents a total of $133,000. Of that, we collected $123,000, which is a 92% collection. We did have other income, so you combine that. It was $13,626 to the rents we collected. Our total collections for the month is $136,793, and that is what matches to the break-even number. So we're comparing that to the break-even number of $106,242. That puts us at a percentage-wise 129% of break-even, or $30,000 over that expectation. In the middle here, you'll see April. If you were on our last call, we showed you April collections, but we only had till about the third week of the month. So I just wanted to wrap that up for you. So here you see April. We ended April 30th at 95% collections. We did have that additional other income as well. Total collections $142,000, and we ended at 129% of break even, just like we're sitting for May. Now you'll notice on the very bottom line there, as of last week, Sommerset collected $4,661 of April rent in May. That's not showing in the May diagram. We're tracking that separately, but that goes part into, there's a little bit of slower payments going on, so some delayed payments. And I expect that in June, we'll see some May payments as well. Our occupancy is really strong at 96.5%, and we only have one person on a payment plan at this point. So that kind of gives you our reserve summary, our collections, what we have coming in. So the next information I want to share with you is our reforecast. So how this new environment, how does that impact our operations, and what does that look like compared to our budget? So we put this reforecast together, and I'll walk you through what we're looking at as we go through these numbers. So if we follow along on the bottom line here, let's talk through total income. The first block of information you're seeing is our year-to-date actual. So January through April 30th, what we actually brought in, what we had budgeted, and our variance. You can see that at the end of April, we had a positive variance of $10,781 or 1.9%. This middle block that you're seeing is the reforecast projection. This is where we're taking all of the things into consideration with COVID and the new laws and the restrictions on how we're able to operate. And we're reforecasting that is going to, our income will be down by 2.7% of our budgeted expectations. So, or $30,966. So if you take that $30,000 that we're going down, it's offset by the $10,000 that we had coming out of April. So that nets out to $20,185 less than our budgeted expectations. And our main drivers there, total potential rent. We're not able to charge increases on renewals. We're definitely also managing towards occupancy to fight any vacancy and turnover costs. So you're seeing that projection there is 1.6% reduction to budget. Rental adjustments is bad debt. It's just if anyone defaults, we're not able to evict them at this time. So you were seeing bad debt accounts just kind of pile up a little bit. Not too much of a big difference here, only 2% by the end of the year. The other income is also reduced. Late fees, we're not able to charge those. And we're not seeing termination fees. Most people are just staying put. So we're not seeing those lease break fees, which equal generally 1 month of rent. So that takes us to our total, the $20,000 or 1.2% less than our budgeted expectations. So let's keep that number in mind as we move into the next category, which would be our expenses. And I'm not going to walk you through all of these numbers. So we'll focus again on that bottom line of total expenses. You can see that our year-to-date actual January through April in that first block, we did have a positive variance by the end of April of 5.5% or $14,334. We expect savings still by the end of the year, perhaps not at that same rate, so a little bit lower, but we expect an additional $8,455 of savings or 1.5%. So if you take that savings of $8,455 plus the positive variance we ended April, $14,334, we should see by year end a positive balance here in our expenses of $22,789 or 2.8%. So that kind of gives you our overview of income and expenses. So let me walk you through how that all nets out. And you'll see here, I will walk you through most of these. Our top line here is net operating income. So when we ended April, we were positive by 25,000 or 8%. We talked about the reduction in income that we're projecting. However, we're also seeing that savings and expenses. So that nets out to be a change of $22,511 from May 1 through December 31st. That negative 22,000 is offset by that positive variance we had ending April. So our net change by the end of the year is very close to budget, 0.3% off or $2,603. So we're really close there. The next line is what is more significant. That's the debt service. And as Dave talked you through, those details, I'm just going to show you the large numbers, how that's fitting. For as of the end of April, we did have some savings already in debt service as the rate was dropping. So we ended up at $15,000 positive. We're expecting to see another $101,000 as this rate stays low. We'll keep an eye on it, but that's our projection right now. Those two combined together for a total year-end debt service savings of 117,000 or 28%. So that's a significant number there. The two below aren't very impactful. We're seeing asset management fees are based on a percentage of income. So if income is lowered, so are the asset management fees. And the other ownership costs, we're not really seeing much of a change in that year end. So our net number at the very bottom, you'll see that we came out of April ahead of the game, 42,606 or 28%. We're reforecasting, if you include everything, the downward projection of income, the savings and expenses, the savings and debt service, that nets out to a positive number of 79,689. Taking those two together, what we ended up April and our reforecast positive variance there, you'll see a year-end change of positive 122,000 or 26.3%. So that's what we're seeing now. That's our projections, but it is a reforecast and it's going to change. So we will follow along with this. This reforecast is kind of our way of we're watching what's going on and how we're managing each asset. We won't have a webcast for you next month, but we will have this for you. So as the May financials are finalized in the middle of June, we'll go ahead and update this reforecast. Instead of seeing January through April, you'll see January through May, and you'll be able to follow along. If we see anything changing in the environment, we will revise our reforecast numbers too, so you can kind of see how all of that would shake out. We're definitely impacted in our environment. Part of following along with all of the reforecast is kind of news and current events. So it impacts our residents. Are they able to go back to work? How is this happening for them and unemployment? So I just have a few bullet points here to share with you about North Carolina as a whole. Their stay-at-home orders were just lifted on the 22nd. So they are just loosening up those restrictions. They're in their phase 2 now, which is safer at home versus stay at home. And that's expected to run all the way through June. There are bars and nightclubs, things like that, theaters, they're all still closed. Restaurants, salons, some select retail, they are able to open. They are basically at a 50% capacity. So it's a slow open. We'll definitely keep track of that. We are seeing childcare facilities and overnight camps that are open. So that in some cases can free up individuals to go back to work if they were stuck at home watching kids instead of going to their jobs. So that's an interesting thing to watch as well. My last 2 points here are about unemployment. Since mid-March, on the 15th, North Carolina has received a total of 1.2 million unemployment claims. That's about 24% of the state's entire workforce. When it comes to claims and their processing and being paid, there's about 529,000 claims have received benefits. There is another 200 claims that are unpaid. Some are 2 weeks old, some are 2 months old. So they still have work to do on getting all of this paid out to their citizens. So we're keeping an eye on that. So that's a little bit of our news. I also want to highlight one other item with you, which is owner distributions. Sommerset has been weathering the storm very well. We've had strong collections over the past 2 months, and we do have sufficient reserves in place. Our January through March, the distributions were at 6.25% cash on cash. We will resume distributions in June. They will be at 5.5%. And we will keep evaluating and keeping an eye on the property, on the collections, on the state, and how all of that is working. And if we need to make any adjustments to that, we'll be sure to let you know. But happy to say that distributions will begin again in June. And with that, I will hand it back over to Dave.
All right. Thank you, Michelle. Very good. Well, that'll take us to the end of our webcast slide presentation. We have not received any questions through email or chat so far, so we will move through the Q&A segment and just invite you to send any questions directly to me or Michelle or Carlin if you've got them, and we're happy to reply individually by email. Also, I'll just make a note that we're posting this audio presentation and April reports to your portal soon, and then our second quarter asset management webcast will take place the last week of July, and you'll see announcements from us and reminders of those in the coming weeks. So this will conclude our special asset management webcast for Sommerset Place. Thank you for your partnership. We'll talk again soon. Have a great day.
Thank you.